Here with us now is Byron Deeter. He's a partner at Bessemer Venture Partners. Nice to have you here.
Always great to be back. Thank you.
I'd love to get your reaction to this idea of creating a new, really, asset class is the ambition here. It's only a memorandum of understanding. There's no contracts here that say they have to raise this money, but they do have that idea of that, at some point we could have securitized, basically GPU markets, I guess, that are traded because there's some standardization. Dream or potential reality?
I think this is a great maturation of the ecosystem. Let's first remind people of macro numbers. $1 trillion is going to be spent by the big five this year in data center capex build-out. That's more than the entire U.S. Department of Defense budget at about $960 billion. It's more than the peak U.S. defense budget, even in war times, inflation adjusted. It's the biggest build-out in private markets history. And so another $500 billion is a statement about the intention for the build. And it's smart for Nvidia for two reasons. One is it counters the criticism of the balance sheet insider deals, the round tripping. The OpenAI gives them the deal, they invest in OpenAI. And to move that off, so it's a clear standalone business case. The second is further ecosystem lock-in. They've done a great job with their software development and the ecosystem there, investing in the companies. Now to have a financing advantage and a structural advantage for using Nvidia GPUs is a financial weapon that they can use to pull in more ecosystem build on their stack. And I think it's incredibly smart, and I think that these assets will be investable.
Yeah, Jensen Huang also sort of coming out against that criticism that says, well, what about residual value? How quickly do you have to depreciate a GPU, pointing to the prices per hour actually having gone up for even older chips. Are you a believer that that will sustain over time? Because that could be an important part of the equation here in terms of what this financings look like.
So they are an investable asset. The demand is going to sustain, but these things always end hard with a hard landing. We know how these build-outs play out. And so there's a timing question. And if I'm an investor looking at this, I'm looking at the Class A credit, I'm looking at long-duration take-or-pay contracts, and I want that Tier 1 partnership structure to go with it. Because at some point, the marginal providers are going to get hit hard. We're starting to see leverage come into the market where people are trying to put debt on these things to juice returns as the model returns are coming down. That's only going to compound the risk, and the marginal providers are going to get hit first as there's some inevitable pullback.
I mean, does it raise credit risk, like that future demand is going to be more sensitive now to credit conditions and credit volatility? That feels like a big risk, no?
At multiple layers it is. And so starting with the debt side, which obviously has some backstop protection. But if you think about the equity tiers, part of why Nvidia wants to move this off their balance sheet is for more clarity. They've been, I think, appropriately taking the criticism that they will be tied then to the fate of those who they fund. If you can move it off, have third parties justify it, they're still committing to a quarter of the capital up to $125 billion, but that's a discrete amount and an investment. If you have the folks like KKR and BlackRock that are financing these and valuing them on a standalone basis, people can look at those independent of the GPU business for Nvidia and their core ecosystem businesses.
Demand still seems to be parabolic. Do you agree? And do you see that being sustained for years to come?
Right now, it's absolutely insatiable. And I think that's what investors should take comfort in. The criticism of these insider deals, for instance, were misplaced because they weren't to prop anything up. We were having a chip shortage. It was really to align interests with their participants. The enterprise business right now cannot get enough tokens provision. They cannot get enough capacity. Anthropic, OpenAI, the hyperscalers themselves have openly said they would have grown even faster if they had more supply of chips, of compute, of capacity. And so that's not where the shock's going to come from. We have massive demand that I see many quarters out. Where it may come from is technological innovation, where you find some unlocks, where they can deliver those capabilities, where the model performance can go up. You see these technological breakthroughs that happen in history with each architectural advancement. That's what I think will actually cause an inevitable shock through the system, whether that's the next chip iteration architecturally or whether it's a software innovation. Eventually that will happen, where performance and cost performance is massively disrupted.
That could be a